Hi guys, welcome to another episode of The Aspiring Entrepreneur. I'm your host, Hamza Chowdhury, and in this video, I'd like to talk to you about how to trade from here on out. Today it's October 18, 2020, and I know a lot of you guys are wondering, what's going to happen with the stimulus bill, who's going to be our next president, and there's a lot of volatility you've seen in the markets, and it's incredible what we're seeing, some of the buying opportunities, some of the shorting opportunities. And so in this video, I'd like to just talk to you about some of the tips and tricks that I think could help you become a better trader and given the circumstances that we're in. Before I do so, I'd like to ask a favor of you. If you could just hit that like and subscribe button to the channel. We are a 100% free content channel, and I hope with videos like this to help you with your trading goals. Okay, guys, so if you could hit that like and subscribe, I'd appreciate it. And let's just jump right into it. So today is Sunday. Nancy Pelosi, who's the House Speaker, the leading Democrat, had actually announced that she's confident that we are going to have a stimulus bill before election. And this has been kind of a cyclical thing where we hear from the president that we're not going to have a bill. He said that 2 weeks ago on a tweet, and the markets had tanked. And then all of a sudden, 2 days later, he kind of walked back that statement. And now sort of daily, we're hearing this, we're going to have a bill, we're not going to have a bill. And then some of you may ask yourself, why is that a big deal? Like, why should I care about the stimulus? And the answer to that is that it affects you and it affects everybody, and it affects obviously the market. And why does it affect the market? Because with stimulus money, you're essentially pumping money back into the economy. You're pumping money into people's pockets so that they can go out and pay for stuff, buy stuff. They could invest in stuff. A lot of people, right, might be investing their money in the stock market. So when you have a stimulus bill, the idea obviously is to inject it in the economy. And with the PPP, which is the Payer Protection Program, the objective there is to really keep businesses alive. And so if you remember when we had that incredible like 16% unemployment rate sort of early in the pandemic, and now we've dropped it below 10%, a lot of these businesses are going, bankrupt. A lot of businesses were going out, and the only way to really save them was to obviously give them cash to pay for payroll and to pay for obviously their overhead and expenses. So we have the stimulus bill that's really there to help almost everybody, including big and large businesses, and of course with the PPP, help them stay afloat through these sort of tough times. So when you do that, the market obviously reacts positively. So now that we've heard Nancy say that, don't be surprised tomorrow, Monday, October 19th, if you see the market gap upwards in anticipation that there will be an approval. And then we've also heard the president in favor of a bill as well. So just generally speaking, when you hear positive news with the stimulus, you can expect that the market's going to react well. And so one of the first things I want to talk to you about is size in your risk. If you see the market has gapped up overnight and it's trading higher, then there's a chance that the market could potentially correct itself at open, right? So if the market, for example, gapped down, which it had a sell off on Friday, now it's going to correct itself, and let's say it gaps higher tomorrow morning. One of the things that you're going to always think about is that you're going to have selling pressure. You're going to have people who are stuck in trades, who either got caught holding the bag, whether it was for 1 day or 1 week or 1 month. And so there's always a selling pressure of people who are like, should I get out? There's constantly people coming in and out of the market. There are people through this whole pandemic who've been on the sidelines waiting for that right opportunity to get in the market. So you're always going to have this influx of cash coming in and out of the market. And when it tends to gap up, you usually see a correction of a sell-off, and then it sort of comes right back up. The thing that I really want to encourage you is try not to fall into this thing, what we call panic sell. When you see the markets tanking, when you see a tweet, when you see something all of a sudden drops, don't be part of that panic sell, right? The reason why we see sell-offs are people are panicking. It creates these massive sell-offs. Look at it as potentially dip buying into your long game. So if you're someone who is into the long game, someone who has a retirement account, and you profit and are looking at long-term growth and large cap, mid cap stocks, whatever stocks you're trading, think of this volatility that you're going to see from here on out to the election as opportunities to dip buy, to add to current positions, to add to positions that you're already carrying, and to lower maybe potentially positions that you had that you bought maybe and you overpaid a little too much, right? So when you have volatility, it's not necessarily a bad thing. That's what makes the market the market. That makes us sort of bring in new money and get people flushed out, right? The people who panic sell get flushed out. They sell their positions. So try not to, be in that position. I've panic sold, and what's the first thing that happens? You panic sell, and guess what? The short sellers are flushing out, and then what do a lot of people have to do? They buy it back. They dip buy. And so the stock, you'll see a lot of times, right, when it dip buys, you're dip buying, you're just buying it right back up. So the handful of times I've actually been in that situation where I was one of those people that panicked, you look at the stock and 5 minutes later, you're like, well, what did I just do? Right? Just because the market's selling off at that moment doesn't mean it's selling off for the next few hours. It's just for that moment, for that, that hour or that half hour, whatever it is, and it comes right back up. So try your best to just kind of recall it and train yourself. And it's not something that's going to happen overnight, but it's something that with practice, you'll understand, like, this is just a market sell-off. This is expected, and to hold on to your positions. And I'm talking about even some of these FDA approvals that I did in my last video, where I talked about the FDA approvals and how to trade them, is that you'll find that certain stocks will just tank with no news, and all of a sudden they get bought back because institutional investors are constantly trying to get people with stop losses, which is when you put a stop in your trading to get you out of a trade. And when they flush out the stock, a lot of those stops get triggered, right? So you're buying as they're sort of dipping down. So one of the things that happened this week, for example, the stock that I cover a lot, which is Apple, is that you may have noticed that it got pumped up a lot. So I had a lot of people, I mentioned in my earlier video on Apple, that people were thinking this thing was going to go up to 130, that the event was here. And I mentioned in my video before the event, leading up to the event, that try to do what most people don't do, right? So we know that this is a good event, that the iPhone's going to be launched. Most people are thinking that, oh, I'm going to buy in, I'm going to buy in. And so what they do is, as short sellers build up their short positions and you're buying up their shares as they're selling them to you, the moment the event happened on Tuesday, they didn't even wait for the event. Unlike the last event, they actually, the moment the market opened, Apple tanked from 127, 126 all the way down to 121, 122. That's not for no reason. That's because as it was being pushed up, it was being pumped up before the event. It was essentially dumped on the day of the event. So now a lot of people, we mentioned this in the previous videos covering Apple. Imagine if you were someone who was holding the bag a month ago in early September, where it was in the 120s. I mentioned in the earliest videos, we're going to have a lot of selling pressure, right? So we discussed that there's going to be a lot of selling pressure in the 120s for Apple, and that imagine all the people who were waiting for the stock to come back a month ago. They bought it, let's say early September, post split, and now all of a sudden, because of this event, it's at 122, 125, 120. What do you think those people are doing? They're trying to exit their positions. A lot of these people are like, oh my gosh, Apple is, 50 cents from my purchase price. It's $1 for my purchase price. Oh my gosh, I'm break even. I'm profitable. So there's all these people stuck in the 120s that were like, I got to get out of this stock. I want to buy again or buy lower. So all of a sudden, as soon as it opened Tuesday when the iPhone was launched, it tanked massively. And that was for that reason, So when you have that selling pressure, you flush out those people, and then of course you get back in. Another thing I want to talk about is, taking profits and try not to limit your swings. Like we mentioned, one day there's a stimulus, one day there's not, one day this event's happening, So to minimize your risk, try to limit your swings. So if you're someone who's day trading, of course, you're buying and selling the same day. If you're someone who has to swing, just try to limit your risk. What I always tell people is try to take a quarter off. If you're in profit, there's nothing wrong with taking profit. People don't go broke taking profit. So try to take a quarter of your position off. And as you're taking your position off and sort of unwinding your position, adjust your stops, right? So if you're using stops as a way to get out of your trades, you can always adjust your stops to break even. And as you are locking your profit, the worst thing you can do is, as you adjust your stops, is you could break even on the rest of the trade. So that way you can allow your winners to go, but also keep in mind that we're in a volatile market. So what's working for you today may not work for you tomorrow. Okay. So earnings season, one of the biggest and most opportunities is always going to be an earnings season. We are now in the fourth quarter of the year, and we are just launching in the last couple of weeks, the third quarter earnings. And so one of the things you should note is in the third quarter this year, we saw a lot of Chapter 11s, a lot of bankruptcies, a lot of companies going under. And so one of the things that we need to do is kind of recognize what companies are we trading and where are those opportunities. For example, we know both tech, the Zooms, the Facebooks, the Apples, those companies have done well. We also know consumer goods, the Wayfairs, the Amazons, those have been doing solid, right? Overstock. But which ones haven't done well? the financials, the Bank of Americas, right? We know the travel, the carnivals, the airlines, those haven't done so well. So manage your risk and plan your trades accordingly, knowing that, is it worth holding through earnings? Is it worth holding, through carnival earnings when people aren't taking cruises? Holding the stock that maybe might have ran up, right? People ran it up and now all of a sudden it's going to tank after earnings and people are going to lock in their profit. So guys, take and manage your risk is the key. Pay attention to the news as much as you can. And like I said, I wish you the best during this sort of difficult time for everyone to kind of figure out where's this market going. With that said, if you have any questions and comments, please add them below. If you liked the video, again, please hit the like and subscribe button, and I'll see you guys on the next video. Take care. Bye-bye. Thank you.